do we talk about China? Or you want to talk about the Fed? What do you think is the bigger story?
There's so much. Honestly, the Fed. Come on, it's the Fed. It tends to drive
Are they
everything
gonna
else. Well, of course, what do you mean by pivot? We've got some people use it as it's a slowdown in the pace of hikes, which Powell actually has already signaled is probably going to happen this month.
Yep.
I think the pivot that matters is the cut in rates there. There's clearly much less certainty about when exactly that's going to happen. The market wants it now. Powell saying not quite, and that's what we're going to have to deal with in the months ahead, frankly.
Right, and treasuries have rallied on the back of, I guess, hope. What do I do now with treasury yields at these levels?
Well, we're cautious at this point. With the rally that we've had kind of in the belly of the curve 5 years or so, we think that's the part of the curve where we see the most potential for a reversal in the rally that you've seen in yield. So we think the market kind of listened to the beginning of Powell's statement about the next hike likely being slower, and then seemed to have stopped listening at that point, where he then went on to say we need to have rates in restrictive territory for a while, and that means, it could be 2024 before we honestly see a hike, or at least the end, whereas the markets are looking for something in the spring.
So, Daniel, is still the trade for 2023 short duration, short equities? What is the strategy moving forward?
Well, currently we're neutral on duration, so we've been short most of the year. We're neutral now. Now, given the rally that we've had, I'm sure we'll be rethinking that probably on more of a tactical level. But if we think for the course of the year, at some point, of course, you do want to go overweight when you get closer to a U.S. recession, and the Fed is in a position that it's cutting rates to support growth. But, that's clearly a much longer-term view. On equities, neutral overall, but really looking for the relative value plays, because I think that's going to be the story, at least for the first half of the year.
Relative value, is that China? I mean, from what we've seen in the last few weeks, is it a sign of a turning point for you?
Well, yes and no. So we are overweight EM Asia and China. That's actually been, or that overweight's been there for a while. But as we do see the recovery, and kind of the one that we hope to see in the recovery, particularly when we think about the discount in valuations of China versus the rest of the world, as that gap closes, we're actually looking to reduce the overweight and get back to neutral. But we certainly like to see a bit more of a rally in the market.
And what's the view, and you might bring a very unique view to this, what's the view in Europe right now? How do you feel within Europe, and how do you think the outside, the non-European investors feel about Europe, and what do they need to be thinking about?
About European equities?
Yes, about European assets in general.
Well, I think it's going to be a different year next year insofar as this year has been really lousy for the markets, but actually pretty decent for macro, if you look at your GDP figures. Next year likely to be a bit the reverse of that. So even if we're in a recession arguably in Europe right now, we're underweight Europe ex-UK equities, but reflecting a lot of just the geopolitical risks that we're very much aware of. We just don't know what's going to happen in Ukraine. If you did see bad developments, the market's going to nonetheless is going to fall significantly, kind of regardless of the fundamentals. So we're really cautious towards Europe ex-UK equities right now. Need to get through at least part of the winter to feel like you're not going to have any shutdowns or blackouts along the energy front. Hopefully progress in Ukraine, and then things will look quite different, but that's probably months ahead.
Okay, have you been, I don't know, the discussions I've had since I got here to Singapore a couple of days is really in the private markets. I mean, since you're on the buy side, just generally, what's your sense of how painful 2022 has been really on correlations in public assets, and how much really should investors be looking at alternatives, I guess?
Well, I think it's interesting to phrase it that way. So on one hand, after what we've gone through with your 60-40 portfolio, you want to look for any kind of refuge, and private markets should certainly be part of that. And I think that is what's going to continue to drive interest. At the same time, I think we'll again get to the point that Treasury yields at 4%, and so alternatives to that risk-free, hopefully, return matters as well. So you think about emerging market assets, you think about private assets. How much is the illiquidity premium worth to you now at 4% compared to 1.5%. So I think that's all part of the calculation that investors will be making, and also they're going to be thinking about kind of rebalancing portfolios. I mean, clearly on both the fixed income and equity side, it's worth less than you had at the beginning of the year. So what does that then mean for the other parts of your portfolio?
Yvonne has a final question for you.
Final question, your biggest conviction in what asset class, in what sector, or whatever it is. What do you have the most conviction for 2023?
Well, certainly for right now, our biggest and I guess highest conviction overweight is to European investment grade credit. If you look at spreads for corporate credit, say in the U.S. and in Europe, you see the biggest gap relative to history with Eurozone investment grade credit. So you have high spreads relative to history, whereas the fundamentals, certainly from an investment grade credit point of view, we think are good. We've had, to be honest, good earnings for European corporates this year, so we're not worried at all or much about their ability to make the interest payments in the year ahead.